Hi everyone, it's Matt Barnes here. I'm the lead trainer at Safety in the Market, and today I want to talk about why you can make more money trading in commodities than stocks. This is taken from W.D. Gann's book, How to Make Profits in Commodities. And Gann says that a study of commodities will return rich rewards, and he gives 18 reasons why you can make more money trading in commodities than in stocks. These are taken from his book, How to Make Profits in Commodities. And if you're a Safety in the Market student, check out Appendix B of the Smarter Starter Pack for a complete guide to trading futures contracts. Because if you want to trade commodities, you're going to need to know how to trade futures contracts. So let's jump straight into these 18 reasons why you can make more money trading in commodities than in stocks. Reason 1, Gann says commodities follow a seasonal trend and are much easier to forecast. They move with supply and demand. So Gann says that because of their seasonal nature, we know that at certain times of the year we plant crops, at certain times of the year we reap those crops. So according to that, Gann says that they follow a seasonal trend. They should be much easier to forecast. Reason 2, Gann points out that it requires much less work to keep up charts and calculations on commodities compared to thousands of stocks listed on the New York Stock Exchange and all the other global exchanges. So Gann is saying you might keep up charts on 5, 10, or even 20 of the big commodities, but that's a lot easier than tracking thousands of different stocks. Reason 3, Gann says there are no cross currents as in stocks, with some stocks declining to new low levels and others making new highs. So while there's a general trend of the overall stock market, the reality is that most of the commodities move in very different cycles. So we have a lot more opportunities for trading there and less cross currents, as Gann calls them. Reason 4, Gann says in dealing in futures contracts, there are no heavy interest charges as there are when you are long of stocks, and no dividends to pay as when you're short of stocks. So if you're buying stocks on margin, for example, there are going to be interest charges. And if you're short selling stocks, while there might not be interest charges, there'll still be dividends to pay if the company that you're shorting pays a dividend. So Gann is saying that's the benefit of futures contracts. You don't have those interest charges or those dividends to pay as you do when you're trading stocks. Again, Safety in the Market students, if you're not sure about futures, just check out Appendix B of your Smarter Starter Pack, and all of the information that you need is in that one chapter. Reason 5, Gann says dividends can be suddenly passed or declared, which will affect stock prices. This cannot happen to commodities. So essentially, a lot of people will buy a stock because it pays a dividend, or they'll sell a stock because it stops paying a dividend. But the reality is, as Gann said, a company that's paying a dividend consistently can suddenly pull that dividend away, and that's really going to affect the stock price. Accordingly, a company that's not paying a dividend may declare dividends because they've had good profits, and that's going to rapidly affect the stock price as well. So there are more announcements that can come out that are going to affect an individual stock than are going to affect a commodity. So Gann is saying this cannot happen to commodities. Reason 6, Gann says that pools cannot manipulate a commodity as they can a stock. So when you've got a large group of people all buying and selling together, Gann is saying they're not able to manipulate a commodity in the same way that they can a stock. Reason 7, Gann says facts about commodities are generally known, while many stocks are mystery stocks all the time, and some stocks are subject to false rumors. Gann was actually known for having his own plane that he would fly over crops to inspect conditions. So those sorts of things you can't really hide, if it's been a bad year for crops. Whereas with stocks, a lot of the bad news gets hidden away with creative accounting and things like that. Or false rumors may come out that can also affect the stock price, and that's less likely to happen in the commodities markets. Reason 7, Gann says that the stages of the business cycle tell more about the prices of commodities than they do about stocks. So a lot of people like to point to the business cycle and use that to time their stock investments. Gann's actually saying that that actually helps you with commodities more so than it does than stocks. Reason 9, Gann gives, commodities are governed only by demand and supply. This is not always true of stocks, especially the smaller stocks with less shares outstanding. Reason number 10, Gann says speculation in commodities is more legitimate than speculation in stocks because you are dealing in necessities. An arguable point there. I'm happy to let Gann have that one. Reason 11, commodities are consumed, stocks are not. And this has a bearing upon the ease of forecast commodity prices. So every year, all of the sugar or the corn or the oil that gets created is used or consumed, and it's going to be there again next year, whereas stocks are not consumed. Once you buy a stock, you can hold it for a long time. So the fact that the commodities are being consumed, there's more trading opportunities there, Gann is saying. Reason 12, you can forecast tops and bottoms of commodities with greater certainty than of stocks. Now, this ties back to something Gann mentioned earlier, that he is making the point, as he does in the book, that he finds that it is easier to forecast tops and bottoms, or to forecast the direction of commodities markets with greater certainty than of stocks. And that ties back in to the fact that we're dealing with commodities that are driven by supply and demand. So when it's just pure supply and demand and there's plenty of volume going through there, it's generally easier to forecast where these things are going than when you've got a small stock, for example, with not a lot of shares outstanding that can be pushed around up or down quite a few dollars in a short period of time, just by a few buying and selling orders. That's less likely to happen in commodities. The moves are more pure. Reason 13, stock prices tend to move by groups of stocks while commodities move independently. This is particularly a good thing to note if you're an investor in the markets. A lot of the time, investors, they're all happy when the markets are going up because most of their stocks are going up, or certainly the group of stocks that they're in are going up. But then when those stocks start coming down, they get in a little bit of trouble. As a trader, you should be aware that you can trade both directions of stocks. You can trade long and you can trade short. Short selling is covered in Appendix A of the Smarter Starter Pack for Safety in the Market students. If you're not comfortable with that, you can check it out there. All of the information is there. But Gann is saying, aside from that, commodities tend to move independently. So if you're looking at corn futures, for example, they're going to move differently to oil futures or gold futures. So there are some more trading opportunities there. And if you're trading corn futures and corn is flat, you can easily switch over to something like gold or wheat or another commodity. And because the commodities move independently, you're a better chance of finding a commodity that's going to be moving. So again, more trading opportunities there. Gann points out in reason 14 that notable speculators like Armour, Patton, Livermore and Dr E. Crawford have discovered after long experience that they can make money with greater certainty in commodities. This is Gann pointing out to the public notable names that would have been familiar to the public in the newspapers of the time. And Gann is saying, these people all agree with me that there's greater certainty in trading commodities. Now, it's a little bit like a celebrity endorsement today. It doesn't necessarily mean that you run out and do it because a celebrity says that, but that's the equivalent of reason 14. Gann's pointing out successful speculators that the public were aware of and saying, well, they also agree with me that you can make more money trading commodities than you can in stocks. Reason 15, stocks can go out of business, whereas commodities go on forever because crops are planted and harvested every year. So again, if you're trading stocks, for example, you might own stocks in a company like Enron that eventually disappeared and went out of business, whereas that's not going to happen with commodities. You're trading the prices of those commodities there. So firstly, they're not going to fall to zero because no one's going to give away a commodity for free. But secondly, there are more crops planted and harvested every year. So you can continue trading on commodities as long as you like without having to worry about them going out of business. Reason 16, Gann says there is always a demand by consumers for commodities, which is not the case with stocks. So, for example, Tesla shares in the United States will fluctuate in terms of how much demand there is for them, depending on how much people think Tesla is progressing as a company and how their sales are progressing, or if they think the sales are bad, there'll be more or less supply or demand. Compare that with something like coffee futures. Try telling someone in the morning that they're not allowed to have their coffee this morning. There'll be a little bit of an uprising. So there's always a demand for commodities as opposed to stocks. Reason 17, margin requirements are typically higher on stocks than commodities. Therefore, you can make more money on the same amount of capital by trading commodities. That's still true today, although not by as much. You will find that across the board, margins, depending on what you're trading, they tend to come down rather than go up over time, although there are some whisperings that that's going to change. But margin requirements typically, certainly back in Gann's day, were a lot higher on stocks than on commodities. So if you've got a $5,000 trading account, for example, you can trade much larger positions on commodities than you can on stocks. Again, saying you can make more money on the same amount of capital by trading commodities. Finally, the 18th reason Gann gives is that when you learn the rules for forecasting and trading in commodities, you will see that they never change because there will always be wheat, corn, and cotton crops each year, and these crops will be consumed while stocks change, and you have to study new stocks to keep up with changed conditions. It's a little bit like in the back end of the 1990s when internet stocks started coming out, and that was a whole new range of stocks that were coming out that stock traders would have to keep on top of. Whereas you've been able to trade wheat and corn and cotton crops, for decades and decades and decades. So you don't have to change into the new stocks that are the flavor of the month. You can stick with the tried and tested commodities. And if you've gotten to know a commodity over time, you can continue to use that without having to change into another market. Now, you would have noticed that a lot of those rules overlap with each other. There are 18 reasons there. You could probably condense that down a little bit, but Gann is pretty adamant there that you can make more money trading in commodities than you can in stocks. Certainly, I wouldn't argue with him there, but what I would suggest is that you take a piece of advice out of David Bowden's book from the Smarter Starter Pack, where David says, trade a stock, a currency, a commodity, and a stock index, because sometimes if you just trade stocks, there'll be periods where stocks are flat and they're not going anywhere and you can't really make money from them, but the commodities will be trending really strongly. And then there'll be times when commodities aren't great, but maybe the currencies will be trending well. So the point that David makes is that if you can follow one stock, one currency, one commodity, and one index, you'll always have something to trade that is trending. So you'll always have opportunities for making money. A quick note on futures contracts. If you're trading commodities, they're generally traded using futures contracts, as I mentioned at the start, and you can learn about futures contracts within Safety in the Markets Active Trader program, specifically in Appendix B of the Smarter Starter Pack, which is the first half of that program. If you enjoyed this video, we'd really appreciate it if you click on the like button below, which is the little thumbs up icon, to give us a like, and please subscribe to our channel if you haven't already done so, to keep up to date with all of our future YouTube videos as they're released. Thank you for watching. I hope you've enjoyed the video, and I look forward to seeing you next time.